Hey everybody, Marty Mazur, good evening. This is your weekly video. I think I can keep it kind of quick. I'm just going to take you through the slides we're showing clients during our review meetings this week. And then I want to touch on an event today or a development today that I thought was quite interesting enough to kind of give you a little behind the scenes look as to what went on with one major currency today. In front of you is that 1-year S&P 500 chart with the simple 50, 100, and 200-day moving averages. I know I do this a lot. I do think it's important to continue to address where the trend indicators would suggest we are at the moment, and we are clearly in a bull market at the moment, notwithstanding a testing here of the 50-day moving average by the S&P 500. Look back, just by way of example, in terms of how these indicators work. Here is prior to the dot-com bubble bursting. You see the short-term or the faster moving averages rolling over. When the 200-day begins to slope down, as I've illustrated numerous times here, that becomes a situation where we need to pay very close attention to the volatility, as opposed to a scenario where the 200-day is moving up and we're in an uptrend. You see we came out of that just fine. A lot of noise, a lot of rolling over the shorter term averages, but that 200-day stayed steady all the way up until it didn't, and that's when the mortgage bubble burst, or the real estate bubble, as some people like to think. And the 200-day rolled over, and we had a massive bear market there in 2008. Came out of it just fine, and we continue to be in what by definition of the trend indicators would be a bull market. Here we are all the way back to 1995. You've seen this too many times, I know, but here is the 200-day and the shorter term moving averages working together. And notwithstanding a couple of corrections where that 200-day began to roll over 2 or 3 weeks ago, I painted an economic backdrop here versus here to help explain why we didn't have massive bear markets when we had those rollovers. Looking at financials, which is a notable weighting in our portfolios, looks pretty good right now. We've had some consolidation, some give back here. Today was a rough day for financials. Goldman Sachs surprised with revenue actually to the downside. This would be a very bullish intermediate and long-term setup. Question as to the shorter term look as that 50-day begins to roll over. Industrials, similar look, maybe a little more secure on a short-term basis. Materials, good look for materials. Technology, exceptionally good look with all three moving averages. Same with consumer cyclicals, your Amazon, Starbucks, etc. Healthcare, a little bit of uncertainty here in the moving averages, very flat 200-day. Healthcare is a defensive sector, as is consumer staples. We're not big in defensive sectors at the moment, not because we expect them to lose money in a bull market. We just expect them to underperform the more cyclical sectors that seem to have better trend setups as we sit here today. Excuse me, utilities, very interest rate sensitive. I am bearish on utilities because of that interest rate sensitivity, notwithstanding the decline in interest rates of late on all the global uncertainty. I think if the economy continues to do fairly well, we are going to see interest rates trend higher over time, and that would be somewhat problematic for utilities for now anyway. Looking at bonds, speaking of interest rates, you can see the 20-year Treasury index really has rolled over on a long-term trend basis. We have seen some strength in here of late again on the global uncertainty. Investment-grade corporates mixed with Treasuries, that's the index we have here. Very similar look to Treasuries. We're not going to be bullish on bonds until we see better things happening. That generally comes much later in the economic cycle. Gold has been all over the place. I've talked a lot lately about gold. A lot of people are bullish on gold. It's very geopolitically sensitive, which is why we've been talking about it a lot of late. I'm not convinced that the setup is very bullish. In fact, I think it's somewhat bearish going forward, particularly if the economy continues to do okay and if the trends continue as they have so far. But again, gold will be a place where you see some really big spikes anytime you have any major sounding geopolitical uncertainty. Developed foreign, Europe, Australia, New Zealand, Canada, Japan, etc. Good look so far this year. You can see the setup is very good. We've had an extended period of underperformance there and in emerging markets as well. Emerging markets have been the best part of our portfolio so far this year. The ratio analysis between the developed non-U.S. markets and the U.S. As you can see, they've outperformed the U.S. on a year-to-date basis. Pretty nice beginning of an uptrend here starting in late February for emerging markets in early March. Emerging markets have outperformed the U.S. to the tune of almost 7% so far this year, a little bit better than 1% outperformance for developed non-U.S. markets. The Eurozone itself up 2.5% above the U.S. so far this year. The ratio bottomed in here, pretty nice move, maybe some consolidation. As most of you who've been listening to the videos and watching know, I'm pretty bullish on non-U.S. for the longer term. But of course, our portfolios remain largely U.S. centric, but we do maintain a pretty good amount of exposure to non-U.S. markets as well. So today, the British pound soared. In fact, here's a look at a 3-day chart. This is just an explosion to the upside. That's an unusual move for a currency, take my word for it. The commitment of traders report, this is the positioning, the net positioning of speculators in the futures market. This is extreme pessimism. These folks are making big bets by way of borrowing futures contracts to buy back later. They expect at lower prices to make a lot of money. So you borrow, you sell them now, you buy them back later because you think prices are going to be lower and you pocket the difference. When there's such heavy short interest and the item being shorted moves away from the trade, so to speak, these folks tend to panic in a hurry because you can imagine how much money can be lost. Again, you sold something that you have to buy later. You collected cash with which to buy. If the price goes higher, you're going to have to come up with more money. And if it goes a lot higher, you have what's called a short squeeze or massive short covering, which I can tell you almost entirely explains this huge move in the pound today. The underlying reason was the IMF upgraded Britain's economic outlook going forward. That makes sense to me that the pound would move on that. Also, though, Theresa May announced that they're going to have an early general election. Now, I can't necessarily speak to why that was so bullish for the pound. I can speculate, but clearly she believes that she and her party have some positioning right now that would allow them to do very well in such an election and have them gain a great deal of control in Parliament. So we shall see how that goes. But today, I wanted to illustrate for you, as I have in the past when we've had huge bearishness and short interest in stocks, and then we had those massive triple-digit days in the Dow. You may recall in months and years past where I did a similar analysis on stocks. Well, today it happened with a currency, and this is just to remind us that stocks work the same way as well. There are forces underneath the surface that don't necessarily have to do with a great deal of the fundamentals that can be somewhat confusing when they spark big moves in prices one way or the other. I'll leave it there for today, folks. Thank you, as always, for watching and listening, and in a few days I'll have your weekly message. Take care. Bye-bye.